everyone, welcome. We look forward to speaking with you today. Start with introductions.
And for those of you who don't know me, I'm Liz Carter and I look after our reporting and clearing strategy at TradeWeb. Good afternoon.
And Daniel, could I have you introduce yourself?
Of course, Daniel Mason, and I run market structure and electronic trading at BlackRock.
And Stefan.
Good afternoon, everyone. Stéphane Malray. I run market structure and innovation at ING for the market activity.
And last but definitely not least, Eric.
Hi, I'm Eric Böss. I'm in charge of trading at Allianz Global Investor, the asset management entity of Allianz, the insurance company.
Great, thanks. And as Leanne said, I'm Liz Callahan. I'm on the secondary markets team director, and for my sins, I am involved in everything with MiFID and the consolidated tape. So let's get going on a discussion today. Hopefully you all have seen in the audience, you have seen the poll questions, or that you will be having poll questions. So ideally, we would like you to answer those so that we can discuss. The first question that we would like the audience to answer is, has MiFID II MiFIR-based transparency, so accent on MiFIR-based transparency, improved bond market trading since 3rd January 2018, start of MiFID II? 1, or A, yes, significantly better than pre-MiFID II. B, yes, slightly better than pre-MiFID II. C, no difference than pre-MiFID II. D, no, slightly worse than pre-MiFID II. And E, no, significantly worse than pre-MiFID II. So if you all could answer those questions, that would be great. Okay, now I'd like to turn it over to the panel. Daniel, let me turn this one over to you first. What are your thoughts? Has MiFID II or MiFIR-based transparency improved bond trading since 3rd January 2018 when MiFID II came into force? What are your thoughts?
Sure. Let me give that a go, and disclaimer, this is my first virtual panel. I did have some crackling on the line there, so if my own line breaks up, I do apologize in advance. Has transparency increased? Has it affected bond trading? I mean, in a way, I'm thinking of that in 2 stages. So clearly, I think kind of MiFID I was all about competition, and kind of as a result, we fragmented the landscape. We had new liquidity providers, but we didn't really yet have the transparency that we would have wished. And then MiFID II looked to introduce a host of measures to really get a transparency. And yes, I mean, for sure, there are things that have improved. We've got mandatory trade reporting, and kind of I do think in particular in bond markets that we're talking about today, we are going from a situation of having virtually no data to a situation where we have data. So undoubtedly that is an improvement, but maybe it's more an improvement in transparency itself. And I note your question was, has it had an impact on bond trading? So I suppose that's the real kind of proof of the pudding, in the sense that has it changed our behavior? So while in my view we've seen improvements in data and improvements in transparency, I think that real push through that actually changing trading behavior is maybe slightly more in its infancy. So I mean, I'll be keen to see what the audience says and what the panel results are. But I'd like to think we're moving in the right direction, but there's still a way to go. I'm sure tape and other things will be mentioned, so there's still a few things that I'm missing.
Yeah, Stefan, what about you? Any thoughts?
Yes, I will have to agree with Daniel. In a way, I think the intention to create more transparency made a process in place to do reporting and to do that. So yes, progress has been made because now we have the process to publish data and to have data available. But are those intentions met the objective of MiFID? I don't think so, because very few people yet are able to use this data in their trading activity from the buy side, but also from the sell side point of view. So we are halfway there, right? It's a process are starting, but it's not usable, I think, at this stage. And it's also an issue of data quality. I think it's one is process to publish the data. The second one is how this data quality is good enough to be able to make trading decision from the back of it. And on this front, I think we are not there.
Okay. Eric, what about you? You know, all the transparent, you know, SI quotes that you're seeing coming from websites or APAs or what have you. Are you getting any benefit from those those quotes and the new transparency that MiFID has brought in? Oh, no, Eric, you need to unmute.
Yeah, sorry. Just did this now. Well, I think Daniel already pointed at this. While clearly transparency has moved to a higher level, that was a very low hurdle to clear because pre-2018 transparency in bond markets in Europe was extraordinarily limited, especially compared to the US. So I think there's not a terrible lot you can add to this because the current transparency regime, while well intended, is an improvement. I think that's out of question. But I think if you just plainly compare larger capital markets, and I tend to use the US because it is the biggest capital market out there, single market. The transparency in Europe and the level of transparency that I can actually use in my price finding process, so not necessarily in the aftermath to dissect things weeks later, but rather on a day-to-day trading business with the intention to get the right price of a particular bond. That's why I think there's still a lot of ground to cover. And if Stefan says we're halfway there, I'd probably be a notch more bearish and say, I don't think we are halfway there. I think we just started that race. So I'm more in the 40 camp or 30.
Yeah, tiny steps. Okay.
Well, at least the direction of travel is the right one. So that's a positive.
That's true. I mean, it has set the direction and, you know, set the course. It's just, you know, how long will it take, I guess. Okay, let's see what the audience said. Leanne, could you, okay. Okay, the clear winner is no difference than pre-MiFID 2. So.
Yeah, but interesting enough, if you add up the two yes answers, that's pretty much a draw.
Yeah, okay, that's true. Yeah, we've got yes, definitely. We've got 18% say yes, definitely better than pre-MiFID 2. We've got 27%, which is interesting. Yes, slightly better than pre-MiFID 2. And then we have 45% saying no difference than pre-MiFID 2. But clearly, it's not worse than pre-MiFID 2. So I would say that as well. So what do you all think about that? Any comments about you can see the results too. Sorry, we're all getting used to the new way of doing this.
Well, the thing, it's not an easy balance to do, right? So I think we should defend a bit what the regulator wanted to achieve there on the first try, because it's not easy to solve. And probably that's why, right? For some people, they can probably take advantage of the data available and see some benefits. But for the majority of them, it's still not the case. It's still too hard to get the data, too hard to analyze the data, too hard to filter the data to make any sense of it.
So maybe a good question would have been: is MiFID too complicated? You know, I hear that all the time. Yeah.
I think that would get slightly clearer answer.
I don't even think we need to take a poll on that one. Yeah. Okay. Great. Now, I think questions will be coming in as we're doing this, but we will be taking them at the end. So for any of you taking part, anyone in the audience, we will go over questions at the end. So hold fire, we will get to you. Okay, so let's move on to the next question. Many have recommended a harmonized deferral regime across the EU for post-trade transparency. What are the advantages and disadvantages of a harmonized post-trade deferral regime? Liz Carter, let's go to you.
Thanks, Liz. I think the poll results were interesting. And I do think that, I agree with my colleagues here that progress has been made, but it's a journey and it's an ongoing journey and it takes time. It's a huge change and we just need to keep working with the regulators and looking at sensible changes. And I agree, it's not perfect and it needs some additional work. I do hope that the ESMA transparency consultation paper may also help give some of the answers and some of the pointers there. Coming to the deferral regime, particularly, I think broadly, I think we're all in agreement that deferrals are necessary and are right and are good and are needed in the market space. I think nobody disagrees with that. I think the criteria that's being used to determine the reporting timeframes, such as size of trade, frequency of trading, I think is absolutely the right criteria. So in my mind, I think it comes more down to the application of the deferrals and how they've been implemented. And I think, in my mind, there's kind of 4 broad areas that I think we do need to revisit and we do need to look at. And if I may share those with you, I think the obvious one, the obvious one is probably the supplementary deferrals that we only see for non-equity. I think they are rather complex. There's actually 7, if anyone happened to count them. Yeah. And they're all available for the different NCAs to approve their jurisdictions. And, I think if you look at what the impact they have on the average end data consumer, I think they can be hard to navigate. I mean, if you're looking at transparency on a particular instrument or ISIN, you will find there's different reporting timeframes for those trades, even some with the same size, and that's quite difficult. Plus you have deferral flags that kind of really do not lend themselves to being particularly helpful. So I do think that area is one that does need to kind of be looked at, to be streamlined, and particularly for the evolution of a consolidated tape. I think that's quite critical. I think everyone agrees with deferrals. I think we just need to get it right. I think Sorry, can I just, real quick, you mentioned deferral flags not working. What do you mean by that? Well, what I mean is quite often with the publications, and I'm sure most of us here have looked at publications at some point, they have these 4-letter flags that communicate which deferral option has been applied. And I mean, they themselves, you've got things like SWAS, VOLU, all these sort of flags. I don't think if you're just looking at a raw data set, it's not particularly helpful. And the fact that you've got 7 lots of flags, I think is quite tricky at times to the average user. So I think there is stuff that can be done there. I really do. And I think the second area, which we've talked about a lot, is the interpretations of RTS2. And with all the best will in the world, elements of data is going to get missed, and that's going to then fall to individual interpretations of that data. And I know our APA has been spending a good deal of time looking at this with our member firms. It takes time. It's not easy. It's amazing how difficult it is to get firms to just agree on standard kind of things like notional amount versus quantity. It takes time, and then on top of that, you have the changes that need to happen. So not just to the APA and venues, but to the actual reporting parties themselves. They need to change their processes to make these fields more standardized and use different values. And then you need the QA and the testing. So I hear what people say about the data quality, and I 100% agree. But I think I'm certainly encouraged and comforted that I do think there's focus on this. I think ICMA, for example, the fixed working group, I think we are looking at this together with APAs.
Well, this, just to jump in real quick, and I'll let others get in. You brought up a really good point, which ICMA, we did have a consolidated tape report for the commission. But one of the things that we had in there was a study of TRACE and what did TRACE do really well. And one of the things that they did is exactly what you're talking about. There are no ambiguous fields in TRACE reporting. It's very clear what the industry needs to put to populate those fields. You know, it didn't happen overnight, clearly, but that was something, and testing and everything, that was something we found that FINRA got early on, actually. So sorry, Liz, and anyone else.
I think it was because it was a very targeted set of products as well in the US, right? So here we are talking about a non-equity type of reporting, and even if you put equity, right? So that's why it increased the problem of those flags dramatically. But that's the lesson we can learn from it as well, to try to simplify it again, or give more clear definition of
and
which field should be for which instrument.
I think that's a really good point, Stefan. I think you're absolutely right. I think we have to remind ourselves that this was a tremendous change to the market, and the very, very broad depths of what we were doing. It wasn't just, you know, corporate bonds. It was massive, and you know that does take time to bed down. I think one of the other points, Liz, which I know we're going to come on to later, so I don't want to mention it much, but it does definitely have an impact on the post-trade, and that's the surprising number of bonds that perhaps are deferred, and that all kind of tells into the ESMA liquidity score. So I'll leave that, but I think that does need to be looked at.
Yes.
I think for me as well, I think the other thing that is probably smaller and more of an edge case, but is instrument classification, and this gets a little bit tedious, a little bit boring, to be honest, but it is quite important. So any sort of post-trade transparency report at some point has to be classified. It has to be understood. Even if you have an ISIN, it has to be understood. What asset class is that? What sub-asset class?
Yeah.
Even segmentation criteria. Boring, I know, but it's important. And I think we don't yet have a golden source of that reference data. So upstream, we have various different sources. We have FIRS, we have FITRS, we have ANA has some CFI classifications, and then we have the market data with, you know, big providers like Bloomberg and Refinitiv. And I can tell you, we have situations where each of them says something different. And, you know, that then means that if you're classifying an instrument differently, you're applying the deferral, the size threshold, everything else that goes with that classification differently. And when you look at how that compounds the exhaust data, again, it creates this non-standard data set. And I think, you know, we do need to take the time of going upstream and looking at those reference sources and making sure we're all looking at the same thing and classifying them in the same way.
Yeah, so it's not just consolidated tape at the end of the stream, it's at the head of the stream.
Absolutely, yeah.
Yeah. Okay, any other comments anyone else would like to make about the harmonized deferral regime? Eric, anything from you?
I think Liz already did a good job in outlining the issues that we're facing in Europe, because Elizabeth, your original question about deferral regimes and a centralized versus decentralized one. The European concept is just, in good intention, significantly more complex than what TRACE in the US does. And that's good intentions. But after all that we currently heard about data quality to begin with, the balance that regulators have to strike here is one between I would currently call it an over-engineered approach, but let's be a little bit more constructive and call it a very detailed and precise approach versus something that is deliberately oversimplifying a complex market, but as a positive side effect to that oversimplification is very workable, which is one of the very positive things about TRACE. So while I totally see that the European deferral regime, and again, no one would argue that you don't need deferrals, the question is how do you calibrate them the right way? In its current format, with the current data quality that we're experiencing in the marketplace, has its problems to really work well for the industry because it's pretty expensive to maintain. The benefits we get out of it are limited, definitely questionable if you compare and contrast them with the cost that goes into that system. So I think, again, it's a balancing act. So do you want something that's simple and works, or do you want to shoot for something that's better engineered, but currently faces issues in the early phase where the data quality is just not there?
Actually, thanks. That leads us into the next question quite well, which is how well is bond liquidity assessment? So we've just been talking about transparency, but how well is bond liquidity assessment working? And do you think bond market liquidity and transparency methodology is currently over-engineered? And I think we have an idea from Eric of his answer. Or has ESMA struck the right balance between accuracy and liquidity? So, you know, if we could get some comments on the liquidity assessment methodology, and also any ideas, you know, are there alternative assessment methodologies out there that could work better? Eric was kind of alluding to possibly there might be, but I'd like to hear a little bit more on that from Eric, but also from others on this. Stefan, what are your thoughts on this?
Yeah, I think this one will be the one who probably will need to have some consultation with the industry to be able to find the right solution. Right? It's not an easy problem to fix. I think ESMA in the consultation papers that they produce for the non-equity part of the MiFID review propose some changes in the liquidity assessment. And we're not sure that this one will work either. I think you have to work with different market participants to try and test different models before we publish something or propose something to the EU Commission. We could look at going back to what the US have done on their side, probably to group it by different type of instruments. Because we know already some instrument grouping are more liquid than others, so it could be a starting point. But you know, analysis has to be made to be able to validate those assumptions. I think we're way too early to be able to come back with a magic solution and propose it to the rest of the European market.
I mean, Stefan, if I can just jump in, I'm slightly more reserved on that because I actually think that the regulator has the right idea here to use kind of trading activity data that is actually a measure of liquidity. So I think the idea is good, but we come back to the same problem that you need better data to be able to calibrate it in a slightly, in a better way. It would, I could see things like broader classifications working better for deferrals or for kind of size thresholds like large in scale, SSTI, things like that. I could see that working. I find it slightly more difficult to see how that would work with the liquidity assessment where kind of you bring everything in scope all of a sudden or nothing in scope, and you kind of lose this criterion of liquidity itself, because you will have a huge dispersion of very liquid and very illiquid bonds even within kind of a category, whether that's investment grade or however you want to cut this. So as you say, it's not really an easy problem to solve. I personally would be quite supportive of kind of the ideas that are being put forward to explore this more in a kind of in a group. I think it definitely merits further kind of brainstorming before we come up with something, because it's not obvious that other models will necessarily be a better alternative. Maybe the alternative is to fix the data better, and then actually the current approach would be quite sensible. It's quite a tough question to answer.
Yeah, Eric, any further deeper level thoughts from you on this?
Well, further maybe. What deeper, I'm not sure. Well, I always struggle a little with regulators and liquidity, because if you look at, and I'm moving astray now, but if you look at, for example, the SEC's intentions to regulate fund liquidity and the clusters that they propose for individual funds and assets that are in the funds and whether they are deemed liquid or not, is a good intention again. But the issue with liquidity is it's a very fair game, because sometimes things all of a sudden turn illiquid. Even treasuries experience this if you think back to March, which under normal circumstances would be considered the most liquid bond market. Now, one of the issues that a good regulation should definitely incorporate is a certain level of stability and persistence. What I'm worried about is that when we're trying to calibrate deferral regimes and other rule books around liquidity measures, that they switch too frequent between this is a liquid instrument, this is an illiquid instrument, now it's illiquid again. Oh, no, it's liquid. How do you measure liquidity on the one hand, but the timeframes by which the regulation around this as a result of that liquidity measure is then recalibrated is an additional complex segment to that very same problem. So at the risk of stating the same as the other panelists here, I think that definitely merits further investigation.
Yeah.
Yeah, I think it's very hard in the bond market to calibrate liquidity based on past trading, right? It's not in the bond market. It's not because the bond have traded many times last week that it will continue to trade next week. And that's the challenge. I think it's a liquidity assessment. If it was a perfect solution, it's a real-time calibration. You know that a bond is liquid because you can see on the screen that there is a lot of activities. And this will be very hard to achieve from a regulatory point of view. So we have to find something else to be able to take this liquidity effects.
And to be a little bit blunt here, there's no other asset class I'm aware of that writes different rule books for liquid or illiquid assets. It's an asset, but this idea of regulating on the level of liquidity is a tricky one, and I always considered it a little bit questionable when that found its way into the original MiFID test. Again, I understand why it happened, but I find it extraordinarily difficult to implement in reality. Because as Stefan just said, just because something all of a sudden trades a lot, it doesn't necessarily mean that it's all of a sudden liquid.
No, I know that, I mean, you know, obviously trace, and I'm not saying trace is the answer because a lot of people have said, you know, it's not. And, but an element of that, you know, which we've talked about a lot about this in our various working groups and task forces. And this is, you know, the idea of having a credit rating based on, but sub-asset class level. So in other words, you have something more similar, high investment grade, non-investment grade, and then at sub-asset class levels. So, but combined with deferrals, because as Liz Carter pointed out, everyone does agree with deferrals. Sure, the thresholds need to be worked on based on the underlying data, but you know, something that, I mean, the overall message that I got from our task force was no one really would mind increased transparency if the liquidity assessment was correct. And that was pretty much a message that I got. So there, you know, the industry wouldn't be twitchy about increased transparency if the liquid bonds were actually liquid. Daniel, anything from you? More?
Apologies, my audio froze at that point in time. But there's kind of, I think kind of we've kind of agreed here that this is kind of quite a tough nut to crack, and kind of I would kind of maybe restate the point that someone else had made before, that kind of we do also need to balance this with complexity. So I guess my main caution is, let's not move too fast, and let's build a system that really works. I think that should be our main goal, and sometimes simplicity works better than something that's too complicated.
Yeah, and we have suggested carrying out a study with ICMA members into an alternative liquidity assessment methodology to see if, number one, if there is a better one out there, but also number two, if, you know, if it is a bit better, and let's say it's only slightly better, if it is so disruptive for the market and industry participants to migrate from what we currently have today, via COFIA, to say a credit rating liquidity assessment, you know, if the benefits don't really outweigh the costs of migrating, then you know, the suggestion would be not to do it. But I think a study into this certainly would be useful. And we do have some members who would like to assist ICMA with this, because we would need their data. So that's something we will be looking at. And
I think
Liz,
that's absolutely right. I was just going to say, Liz, I absolutely agree with you and the other comments made here. I think significant changes may be needed, but let's do our homework first. Let's make sure that, you know, we only change what we really need to, and we're very assured of the outcome, because, as you say, significant changes come with cost, resource, time, and I think we've all invested so much already in MiFID 2 and MiFID. I think it's really key that we have a prudent approach and are sensible with the changes that we do make.
yeah, and who knows, maybe the study will come out with something completely different that we don't know until we do it. So, you know, who knows? Okay, so let's move on to my favorite subject, consolidated tape. And we're actually going to start this with the second polling question, which is, during the height of COVID-19 stressed markets, would a fully functioning consolidated tape have helped bond trading? And the answers are 1, yes, 2, no. So I will be very interested to see what our audience thinks about this. And we'll get on to that in a minute. So I'll let people answer that. But we'll go into a couple of questions beforehand about consolidated tape. And then we'll end with reviewing the polling question. Okay? So the next question is, some of the most robust discussions in the Consolidated Tape Task Force, this is ICMA's Consolidated Tape Task Force, concerned governance models, investment firms self-reporting to a consolidated tape provider, data ownership and licensing of raw post-trade data, and finally, revenue sharing and tiered pricing. Why are these areas so potential, or why are these areas potentially so contentious? So, Stefan, I'm going to go. What do you think?
Yeah, I think we had many meetings on that, on many different views, but it's important debate to have, because in a way you create a new service and a new commercial entity who is going to generate revenue out of it. So you have to think carefully, you know, what is the ownership of that new data entity? What is the commercial model? What is, and every, part of my role is to look at innovation and a lot of fintech company, and that's the normal way of working for them, right? When you have a new business model ideas and you try to go for funding, you have to explain how you are going to generate revenue, how you are going to give back some of the benefits to your shareholders. Same thing apply here. So those are valid questions that we'll have to go through as we do. And I think the position from the task force where we want to be on the table with the regulator to discuss those points because we saw it in other places. We have experience on that. And we think having the buying and support from the industry, from the future clients of that entity, will be a huge benefit to it, because then you make sure you design a technical solution, but also a commercial model will benefit your future users, and you bring the commitment to the table even before you build the solution. So yes, I think worth talking about it, but making sure we are at that table when things start to get organized.
Okay, and Eric, what are your thoughts? Why were these areas in our consolidated tape task force so contentious? In other words, people maybe disagreeing or coming with very different viewpoints, etc. What are your thoughts on this?
Well, I think because it impacts a lot of vested interest in existing businesses. I mean, there's been a lot of money that went into building the infrastructure for MiFID reporting. There's all the APAs that exist out in the market. There's data vendors which make a lot of money by selling data. And so those are all interests that found its voices in that debate. And as Stefan just said, the issue with forming such a very central data pool is manifold, because on the one hand, you want it to be very complete. So all the data should be in there. That's one part. But the other part is you clearly don't want to create a monopoly in the middle of the market again, which brings the question of ownership and governance. Now, if you make this a government-owned utility, you would, no offense, but most likely throw innovation out of the window, because usually governments are not the most innovative market participants. And frankly, that's probably not even their role. So you want private investors in this to keep it innovative. Then again, if it's a monopoly, how do you get it to be creative? Because there's no competition. So it is, I really find it one of the most difficult topics in this whole discussion, because the ownership, I have to say, I personally have not come up with a good answer for me, what I think is the best structure for the ownership and governance of the consolidated tape. I can make at least 3 different cases that could work, but they are all balancing acts. None of them is, this is it, I think this would work best.
Yeah, that's why we put forward four potential governance models, because given that the commission said that they did not want ESMA to outright own the consolidated tape, we had to come up with something. But in our discussions, like you said, it very much was the case, well, this could work if people did this, but this could also work. So we kind of put 4 governance models as potential for and then, like Stefan said, but we need to get in the room with the commission and really talk to them and hash this out. Daniel, what are your thoughts on this? Because you've been looking at this not only in I think in bonds, but you've also been looking at it in equities. But obviously this is relating to bonds. But what are your thoughts?
Of course. I mean, at high level, I'm not surprised, to be honest, that we had contentious debates, because it really does get to the kind of DNA and kind of the heart of what a tape is supposed to be. And naturally, different views, and naturally it impacts cost considerations. It impacts business models of participants who make money off selling data and adding data value add products. So it is not surprising that what an investor might think is optimal for them might be different from what someone in the ecosystem says. I would kind of still say though, I had a sneak preview at some of the Q&A as well, and someone asked about the tape and the relationship with the deferrals, etc. I mean, at a very high level, despite all the disagreement, I do think it's important to recognize that, to me, I see very little alternative to a consolidated tape, because it's really kind of the grease and the kind of the engine to progress a lot of topics. I think kind of no matter which way you turn, you need better data to make better deferral decisions, to make better liquidity assessment decisions, to be able to open up new channels of execution and more information to retail investors across the board. So to me, the consolidated tape is without alternative, really, and it would be a tool that would allow the market to actually develop solutions for trading, while at the moment sometimes I see regulation that some for those outside of bonds, they might be familiar with double volume cap and similar constructs. Sometimes I see regulation trying to regulate for a desired outcome, but it's actually very hard to regulate for kind of a resilient market or a liquid market. Yes, you can write it into text, but that doesn't make the market liquid. And instead, I think we would, as an industry, stand a better chance if we had the right data, because it's the foundation to get us to that point. That's why, despite kind of the contentious nature, I'm definitely a proponent of the consolidated tape, because I do think it is just a necessary stepping stone on the evolution to modernizing the bond market.
Yeah. Okay, Liz, did you have any comments? Thanks, Daniel. Yes, I completely agree. Liz, any thoughts?
Yeah, I mean, I think Eric raised a really good point. I think the way the CT kind of positions itself, it sits kind of a whole breadth of the market, so it impacts so many. And I think the contentiousness comes from people just simply wanting different things from the consolidated tape. On one hand, you know, you have data providers, you have the APAs, the venue, the APAs have done significant stuff with data already. They need to be incentivized to that data. Then you have the data consumers who, you know, absolutely want accurate data, good value, reasonable, low cost, and to Eric's point as well, a substantial market share needs to be available, and they want it in a centralized hub. And then you've got the kind of CTP in the middle, and having to sort of have the balance and satisfy both of those needs. And it is a big challenge, you know, because there's varying perceptions on what different people need depending on their roles in the market. But I think, you know, I'm hopeful. I think it's one that can be overcome. And I think quite important, which we haven't really talked about so much, I think what's quite important is that the consolidated tape provider is run as simplistically and low cost as possible. And I think what can help with that is just being clear that the primary remit of the CT is data ingestion, aggregation and dissemination in an easily accessible way to all market participants. Yep. I think if you start adding on top of that, you know, deferrals, data cleansing, data standardization, you've got APAs that do that. If you start adding that on top, very quickly your cost will rise, and that can only have one impact. That's going to be borne by the consumers of the data. So our view is keep it simple. It will help with speed to market and maybe evolve it in young, but start simple. Otherwise, you're going to have a difficult job even getting it off the ground. The costs are just going to spiral.
Yeah, I mean, you know, we did have, that's why there's the concept of revenue sharing in there based on the data quality scorecard, which you were instrumental in delivering, Liz. So, you know, that way, we built into our proposals to the Commission the incentive of, if you get a good score on your data quality scorecard, you would get a greater percentage of share of the revenue share of the CTP. So it does incentivize APAs or trading venues that aggregate data. It's only for people who aggregate data, so, and cleanse the data. So this isn't about cleaning your own data.
And I think the point there, Liz, as well, is I think it's, you know, if we already have a process that captures the data, cleanses it, standardizes it, let's not chuck that out. Let's leverage what we have, keep costs, and have the CT primary focus on aggregating that data, getting the required market share, and centralizing it, and go from there. If we start doing too much, and we don't leverage what's already built, then that in my mind isn't a good solution.
Well, also one of the things we did learn from MiFID and what we also learned from Trace and FINRA and how they approach things. They approached you know, building a consolidated tape in a staged process. I think anything that we do, you know, MiFID 2, most people think was too much of a big bang. And it would have been an easier thing to roll out in a staged process, either by different asset classes or post-trade first, then pre-trade, if pre-trade it's even needed, whatever. But most people think it would have run more smoothly had it been staged. So I think to your point, Liz, it's the idea of, you know, the consolidated tape aggregates and consolidates, you know, it's in its name. And you know, deferrals and deferral management and that sort of thing could be looked at later, but first let's have it do job number one, which is to consolidate, right? Yeah. Okay. Next question. Okay, there is a rumor that the Commission has stopped work on all this work we've done on consolidated tape. But there is a rumor that the Commission has stopped work on the consolidated tape for bonds in order to deal with COVID-19 and related recovery. Very understandable. The rumor is that the legislation and Commission focus has now put initiatives into 3 delivery buckets. The first bucket, COVID-19 related items for recovery purposes, which is summer 2020. So that's what we're in right now. And that's the delivery for that is right now. And then urgently needed items, but not COVID-19 related. That is autumn 2020. And then finally, non-urgent items, but still important, is sometime in 2021. And we're told that consolidated tape is potentially in that bucket. What does this mean for market participants and regulator momentum and the likelihood of an EU bond consolidated tape emerging? So is this going to slow things down and suddenly the consolidated tape is kicked into the long grass? Daniel, what are your thoughts?
It's hard to kind of...
Sorry for interrupting, but don't you think this would be a good time to look at the results of the poll? Because we haven't seen this and it touches on consolidated tape. So that might be helpful information for this conversation now.
Okay, yes, we can do that. I was going to do that next one, but I can do it right now. Okay. During the height of COVID-19 stress markets, would a fully functioning consolidated tape have helped bond trading? 64% said no, 36% said yes. That's interesting.
I wonder if the key is in fully functioning. And I wonder if people were maybe assuming it would be the data today that's out there. But if it was a fully functioning, efficient, effective, would it have helped?
That's why I put fully functioning. That's why I put fully functioning. Yes, not sort of, you know, the early attempts at a consolidated tape.
And I think a lot didn't reply as well, right? So it will, so you have, unanswered will be like 3-4 times bigger than the people answering these questions. So maybe the subject is not well understood to be able to.
Well, also, in all honesty, I think traders would answer this question differently than maybe people who aren't actively in the market. Eric, I'm going to guess that you're probably going to answer this in a different way than maybe a data vendor.
Possibly, but everybody knows that I'm a huge fan of the concept of a consolidated tape, so you would expect me in the yes camp, but with that particular question, I would have clearly answered no, because the problems we face there simply, in a liquidity event, the fact that you know that things potentially traded would have helped a very little bit, but I'm not sure that would have really helped, simply because the problems were slightly different. I think the merits of a consolidated tape work out on regular days, even on volatile days. But in a full crisis mode, like what we experienced in March and April, even I would challenge whether that would have helped a lot.
Yeah, I think the truth is a little bit in the middle, in the sense that on the one hand, there were certain areas where I think the tape would have helped. So we probably all saw kind of things like algorithmic pricing nosedive a little bit. We probably also all saw it difficult to just source prices per se, and it was just difficult to know where instruments were trading, so kind of staleness of data, etc. So there are areas like those where I think a consolidated tape or data would have helped. I think it may also, if we had had the tape before then, we might have had models that had actually been kind of tested and calibrated. Now, in fairness, if you calibrate and test something, you need to have had that kind of event in the past. So I suppose even if we had a tape with data, we still didn't have a March-like event in the past. So maybe we would have quite calibrated on wrong data anyway. So there's clearly kind of areas where it would have helped. And if I look forward, I think to a certain degree, workflows like portfolio trading and other things that kind of just make trading more automated and simpler would have been good tools. And having data, I think, kind of would have helped us on the journey to get there. At the same time, there was also just a dry up of liquidity, and that kind of a tape per se wouldn't have necessarily addressed. So I do think there are also kind of areas where, yeah, it would have been nice to have a tape, but we would still just have seen how illiquid things are, but it wouldn't actually have created liquidity as such. So I probably kind of would be slightly more on the positive side, but I totally see the fact that a tape in itself would not have been the kind of panacea to all liquidity challenges that we were seeing.
Well said.
Yeah.
Yes, I think I will be more in Daniel's camp on this one than Eric, but because I think more data will be more useful than no data, right? So for the moment, we don't have a tape. We have, as we said from the start of that webinar, we don't have a lot of transparency available, and so it will have help. But yes, it will not have solved the liquidity issue we have seen in the bond market for sure. But it will have helped some of the market players to have a better understanding of what was trading and where, and to be able to make better decisions. I think so. And also because if you look at other asset class during the pandemic in FX and equities, we didn't have the same challenges. So there are very different type of products, but the challenge we faced in the bond market didn't appear at all in FX and equity in the months of March and April. They don't have a tape either, but they have more transparency available and more data points where people can calibrate in their algos. And I remember in a few calls I had, it's true, the FX algos continue to work pretty well during the financial crisis, during the pandemic, sorry, in March. And even some people increased their usage of algos in FX during the crisis. You know, so it's food for thought, I think.
So possibly, and I know Eric may disagree, but I was hearing from people that, you know, possibly more information, maybe not flying so blind, so you know, a bit more confident in helping you to make decisions. To Daniel's point, even if you don't have any information, that even in itself also could help with, you know, instead of just wondering what's out there. If you had a consolidated tape that was telling you there definitely was no liquidity, you could, you know, that is information as well. Is that fair? Okay. Any other comments on, you know, how it would help or not help, or you know, with in a stressed market situation? I mean, I'd love to know if Trace helped in when there was the financial crisis. How did Trace existed back then? Does anyone know or have a view of how Trace assisted bond market participants during the financial crisis in the States? Because it did exist. I mean, it's not as advanced as it is today, but it did exist. Does anyone have any thoughts, or have you heard? No. Okay. Just thought, just running that by you all. Okay. The great thing is any other, Liz, I'm sorry, I didn't ask you on this one. And I know you're coming from an APA point of view. And maybe you could tell us how did the APA function? And I mean, did you have any impacts? I mean, granted, it's people reporting to you, but did you notice anything during the stressed market of COVID-19? Do you think a consolidated tape would have helped?
I think if the consolidated tape was fully functioning, I think it would have helped maybe look back and see retrospectively what had happened. I'm not sure actually at the time it would have helped, but it would have been, I think, useful to have had a tape that you could have gone back to and kind of maybe understood at a later date kind of what happened. That's just my view. I think that could have been helpful. With the APA, we didn't see anything extraordinary happen. There were slightly higher volumes in some instruments, but nothing too untoward. One thing I would like to go back to is the timeline that you mentioned, Liz, with the European Commission, and that perhaps the CTP is now slipping more into 2021. And I think, you know, we're in 2020 now, and we're still in COVID. Hopefully we're coming out of COVID, but we're still there, and probably will be till the end of this year, maybe longer. Who knows what's going to happen with a second phase or whatever. So for me, I don't see 2021 as necessarily too worrying. I think what is important is that we get it right. And I think that's more important than timeframes. And there's things that we can be focusing on now, like the data quality, liquidity assessment, those type of things, making sure that we revisit those so that when we do come to have, you know, to look at the CTP and be ready to move, we're moving from a really strong base. And I think that's the way we need to look at this. So I don't get too caught up in the timeline. I think there's things we can be doing now to prepare for the consolidated tape, and that's certainly something we're doing.
Yeah. Well, there's also, we're thinking when we go back and follow back up with the Commission when they're ready to chat again about this, is discussing, because one of the things we heard that is tough for them is anything that involves trilogue discussions. So that's level 1 changes. But there are plenty, to your point, there are plenty that are not level 1 changes. So, I mean, governance actually is something that's not level 1, and we could have those discussions with them.
Yeah.
And several of the things we could discuss, but then leave level 1 to 2021 when in trialogue, etc.
Exactly, Liz. And I think the more
Yeah.
we can get as an industry in front of it, then to everyone's points here, the more involved we're going to be, and the more kind of we can guide and steer to make sure it does function efficiently and effectively. So you know, I think I'm encouraged. I think there's things we can be doing, we should be doing now.
Yeah, I agree. And we do, and the main thing is we do not want the momentum to slide. So, you know,
Absolutely.
yeah.
I think the other one thing I will mention is I do think it's important that an equity consolidated tape and bond consolidated tape emerge with similar timeframes to keep the market kind of steady. I do feel that. I think rushing ahead with one without the other, I don't necessarily think is a logical thing, but I'm happy to hear what others think on that.
The parallel development, or at least commencement of development. Understanding bonds are going to take longer because of the data quality issue, but parallel development, commencement. Daniel,
Yeah.
any thoughts on that? Because that's, I know you're in equities and bonds as well. Any thoughts on?
Well, I don't have a favorite child, obviously, kind of.
It's bonds. Of course it's bonds.
Classes. I mean, I think the important thing is we need kind of like one size fits all won't work. So maybe kind of more important than the actual phasing to me is I think a tape means something different for bonds than it does for equities. So kind of the realization that it does really it will need to be tailored to the requirements of the instrument. I think that's something I care about. In an ideal world, I'd have both a bond tape and an equity tape, and ETFs, of course, and other instruments. But like in an ideal world, I'd have all of them, and I'd have them immediately. So I'll leave it a little bit up to kind of regulator resources how to solve that conundrum. If it has to be phased, I don't think that phasing is the worst thing in the world, but not because I believe in that that there is a natural sequence. It's more kind of I want something to be delivered, and kind of if it needs to be delivered in a phased way, then so be it. Ideally, I'd obviously have everything immediately, but we'll see kind of what the resources, what the regulatory resources are. Yeah.
Stefan, any thoughts?
Yes, to come back to your question on that rumor of different phase of the MiFID review, I think we passed that point of being a rumor. It's been acknowledged by quite a lot of policymakers and regulators that they're talking heavily about it. The first, what they don't know if they will do, so it will probably not be called a COVID-19 package, but a quick fix or a fix, MiFID fixing issue. And then they will push, but even the first one may take a long time, because even if it's change of level 1, it may take a few months before they agree. So even the quick fix may not happen before the end of the year. And then you start with the second wave of changes and discuss to Parliament. That means the go live for a CT in equity or bonds may not happen for like 2-3 years from now. And this is, I think, a very long time to wait for the demand that we have on that. I think there's still a strong demand to have a consolidated available in Europe. And we should listen to that demand to try to work with policymakers to say, okay, what can we start to do now to prepare for the consolidated tape to happen? And the one who want to pitch for it, they can start already to work on it, right? Because it will be open to someone to develop. So the sooner the start, the better.
Because there's a lot of thought.
Point. I think you raised a good point as saying, you say a European consolidated tape. So we shouldn't forget Brexit at the end of the year and how that you know, that also needs to be, you know, understood and picked up and included in any kind of consolidated tape that emerges. So we need to be cognizant of that as well, and how that works.
Yeah, well, I think we mentioned that in the paper, that we'd like, however it is done, whether it's through country-specific flags or you know, attached, you know, adding on a module for another country. So having a European Union consolidated tape and then adding on a UK module, or having one consolidated tape but having UK with flags, so that you could have country-specific flags, because there was a clear desire to have a virtual European time zone market overview of bonds, and that did come through. So Brexit will just pose another innovative or another challenge to innovators. But to Stefan's point, yeah, I mean, people could get started on this. You know, there are 4 different governance models that we talked about. Somebody right now could be developing one. So, okay, any, just one more thing I just wanted to mention that came up when we were talking about COVID-19 and stressed markets. One of these suggestions was that it helped with risk management, or it would have. A fully functioning consolidated tape would have helped with, you know, risk managers and their jobs in the various firms. Is that, I heard this comment, do you all agree with that? That would have helped with your various firms and risk managers trying to manage what was going on?
Absolutely. If you look at risk management nowadays, risk management is extraordinarily data dependent. And even though at least our risk department is very good in taking holistic views, the more data they have, the more comfortable they feel. So I guess I probably made my point about the tape and the yes and no poll a little bit too straightforward, because it sounded like I was in the no camp. Probably not totally, but I actually wanted to point more at the liquidity issues back then. But I'm quite confident that our risk team would have enjoyed the pleasures of more data to look at. That's a given.
The pleasures of data. That's an interesting one. But well, yes.
Especially trading risk, because kind of in a world that becomes more electronic, risk management is increasingly important. And yet kind of for bond markets, which kind of until recently had a lack of data, it's extraordinarily difficult to do this. And then probably most risk management teams will in some shape or form supplement their work with trader input and the likes, and all of that is very difficult to obtain in a crisis when everyone's super busy and stressed. So kind of data is just kind of so important for an objective second line risk assessment. So and there's probably other functions that we could mention. So it's, I suppose we're focusing on the trading case here, but holistically, I think it would have helped a lot of people. It would have helped clients navigate what is happening in these markets and so forth. So kind of, I suppose it's a fair point. We should think about the benefits beyond the trading cases.
Yeah, the whole ecosystem. So even ancillary services that would come off of a fully functioning consolidated tape would have helped. Is there anything anyone would like to add to sort of close out the panel discussion? We're going to move into the questions right now. Any comments about post-trade or even pre-trade? You know, there's talk of pretty much don't fiddle with pre-trade transparency. Focus on post-trade transparency in a consolidated tape. That's the quick fix for MiFID. You know, any comments about transparency and consolidated tape, or anything more on liquidity assessment?
Yes, I think you're right. I think there's still a lot to do on the post-trade side and demand to do it. So let's focus on that. On pre-trade, it's a challenge because in one way, the way the bond market works, there is already some pre-trade transparency available outside of the MiFID pre-trade concept. To be honest, I don't think the MiFID pre-trade concept was a big success either. You know, and possibility need to be revisited at some point, or to be put on the shelf, because pre-trade transparency already exists and continue to exist directly with financial institutions and their liquidity provider on the trading venue as well, right? So, so it's less of a problem that post-trade transparency where the data is hard to understand.
Yeah, because pre-trade, you're, you know, the likes of Eric and Daniel are getting it from axes and inventory anyway. They're not getting it from MiFIR-based pre-trade transparency, from what I'm told.
Pre-trade liquidity is even harder to measure than post-trade, because post-trade is a matter of fact, something traded at a given price. Pre-trade liquidity is not one number, because liquidity differs depending on who you are as an investor. Retail prices differ from wholesale prices. Price quality might even differ on whether it's requested for a hedge fund or a insurance company. So the whole concept of pre-trade transparency is highly problematic,
yeah.
Even in equities, let alone in fixed income.
Yeah. Yeah.
Maybe that's a good segue to Q&A.
Yep, I think
because,
so.
I can see that someone or a few questions came in, and I'm going to reward the one Jens who kind of didn't submit their question anonymously, and just start with that question. A quick comment in terms of liquidity. Maybe it would help to address with the regulator the 3 levels of liquidity: market depth, the deeper the better, instant execution, and then influence on market depth after trade execution, rather than simply looking at trade volumes for SSTI, LIS. So I guess kind of that's maybe a complicated question. At a top level, I would have said yes, as in I agree with the general sentiment of liquidity shouldn't only be seen liquidity at the touch. It should be seen as kind of the ability to trade, and sometimes liquidity means you need to trade something fast, and sometimes liquidity means you have to do something in big size. So there is an element of how much can be done immediately and how can be done in more of a block style. And I think the regulator needs to reflect that, or regulation needs to reflect that, and recognize that there is room for on-venue trading, but there's also room for block trading and for risk transfer. That's why I always think it's not one or the other. You can't kind of force everything onto a venue, but there's a lot of activity that's very suitable for being done on venue. And there's also execution demand from investors that is suitable for risk transfer. So in general, I think the question does point in the right direction. I do think we need to recognize that there's not one simple concept of liquidity, and there are multiple liquidity channels, and the regulator should, as much as possible, enable all of these channels, rather than having too much of a firm view of it's only one option or it's only the other option.
Yeah, totally agreed.
Yeah.
The complexity of liquidity is something that we're constantly trying to present to regulators. So whoever asked that question is obviously very knowledgeable about the concept and structure of liquidity. But again, that goes full circle with the earlier parts of this panel here, which were about simplicity versus complexity in regulation. And obviously the moment you leave simple numbers and look at liquidity in its whole complexity, so how wide is the spread, how deep is the touch liquidity, I really hope that regulators to a good extent understand the concept, but then molding this into actual regulation is a really tricky animal. And I think we're all in agreement that regulators should understand what they regulate. So good question.
Yeah.
Good direction as well.
Okay, great. Let's move on. We've got few questions here. Okay. Consolidated tape is important, but if there's no change in the liquidity assessment rules, is it likely to end up with poor content? So that's an interesting one, because, you know, if Eric, you've often said, you know, 4-week-old data isn't that helpful in a pre-trade space. So if you're not, you know, if the liquidity assessment is saying there aren't that many liquid bonds, you don't have something that's going into the consolidated tape with any sense of immediacy, how is that affecting you? I mean, would you get value out of the consolidated tape, or should we have a different liquidity assessment so you have more liquid bonds going into it? What are your thoughts to answer that question?
Very straightforward. With the current liquidity assessment regime and the dispersed deferral regime, I don't think that a consolidated tape could work. I think unless that's reviewed and simplified, I don't think we can actually create a sensible consolidated tape that would generate better data points for price formation. Because as you said, it's all good and fine that we get better information, but if I get it in 4 weeks' time, it loses the value for me in the investment process. It doesn't mean that it's then without any value, but I'm not in academia. I'm in asset management, and I need more timely data to work with.
Yeah. Okay. Hence the study into different liquidity assessment methodologies. Anyone else with thoughts on that question?
Yeah, I think this is a good question, but it's a chicken and egg situation, and I changed my view over the last 6 months on this one probably a few times already, because which one do you fix first? And knowing now that the consolidated tape will take a long time to be implemented and to be analyzed and started and the company created, etc. You know, you have to start at some point. And then we said in this panel, we don't want a big bank approach. So maybe if we had, it's true we have too few liquid bonds today, and because even the liquid bonds are not the right one. But at least if we had a consolidated tape, we could test the model with what is currently liquid on a small scale, and then we can try to expand it and to review the calibration, etc. So you can see that way as well, right? To say, build the tape, try to go what's in it, and then try to fix it, because at least you have something to analyze. For the moment, we have no way to analyze any data. But the other arguments are good as well. It's true that we should increase the quality of the data. We should review, simplify the calibration, etc. But maybe we do those in parallel. But a full big bang approach is very risky.
Yeah. Well, you know, and just looking at Trace, they did it in a staged process, and you know, it didn't happen overnight, but it did start with a consolidation of something. So
yeah, I think I'm in the same boat, because you just have to get the boat into water and just simply start at some point, and it is chicken and egg, and kind of we'd risk delaying even further if we say we can't fix the assessments without a tape, but we can't do the tape without the liquidity assessment. So we just need to kind of accept that the world is imperfect and we have to start somewhere. So I definitely get the person who asked the question, they actually understand the concern, and I get that hesitation, but I think ultimately we just need to get started and just start improving the data.
Yeah. Yeah. And it might be, you know, the tail wagging the dog, you know, because it could end up helping data quality. It could help and really visualize elements that maybe right now aren't. So that could help. Okay. Anyone else on that question, or should I move to the next question? Let me see how we're doing.
I was just going to say, Liz, that I completely agree. I think it is chicken and egg. And as I said earlier, I think, you know, if timelines are delayed somewhat with the regulators, there's stuff that we can be doing. So I kind of agree, probably more in Stefan's and Dan's camp, and that, you know, if we can get moving and we can learn lessons, you know, as long as we're sort of efficient in what we try and do, then maybe that is the better way. But, you know, I also hear Eric, you know, and I think one thing you do need to consider is if you do, we come back to that those contentious points, if you do set up a CTP and someone like Eric doesn't find value in the data, then they're not going to pay for the data. So, you know, you do need to kind of consider all options. But I do think there's way forwards that we can look at.
Well, it might make it obvious as to how the consolidated tape can help Eric out. Right now, we're still in the could be, might be, who knows category. So, you know, we'd actually have a consolidated tape with data that's not helping Eric. That's a story that needs to be fixed. Then we'll call it Eric's story.
Please don't.
Okay. Great. Moving on to the last question, which is, this is a good one. Does Brexit affect the development of a consolidated tape? If so, how? And will the UK participate in it? What are your all thoughts?
Well, I think there's the answer in the question.
Yeah, but I think for once it's not a big issue. Right? Brexit is going to bring a lot of challenges, but probably not on the consolidated tape if the consolidated tape provider see value to also aggregate liquidity from the UK. Right? So at the end of the day, it's going to be a commercial entity, and that commercial entity may say, listen, you know, for Eric to buy that data, I better off also try to aggregate the data report from the APA in the UK. You know, and I don't think it's too much of a problem from the EU regulator point of view. It's more a problem for the person who is going to build that tape and make it work. And you know, and I think the point of view from the UK is quite clear that if one exists, I would like to participate.
Yeah. It kind of comes down to equivalence largely though, doesn't it, as well? Because, I mean, if we're saying under MiFID that, you know, APA's venues may be mandated to provide their data, that might be true for EU venues, but potentially not for UK. So it all comes down to equivalence. But I think the point is that for an effective, efficient consolidated tape, it has to include the UK, particularly for bonds and probably for all instruments. It needs to include the UK. So then we need to work on that, and we need to make sure that is the case.
Yeah, that's what I think. Daniel, what about you?
Yes, similar. I mean, I was about to add a similar comment that it is kind of somewhat, or it could be smooth under the assumption that kind of the regimes remain aligned and so forth. And because otherwise it will get a bit difficult with enforcement and governance and so forth. But under the assumption that that is overcome, then yes, technically the UK is just another market, or the EU is just another market, whichever perspective you want to take. And then hopefully you could kind of marry those two up harmoniously. And hopefully it's such a low level point that it's not even worth a political argument, and we just get it done and are happy ever after. So I do kind of live in that hope that it's not like it would be nonsensical not to participate.
Yeah.
So I do hope that it'll play out as a pan-European EU UK tape.
Yeah. Eric, any thoughts?
Yeah, well, I just plain agree. Without the UK, it would be very difficult to make it viable. But again, that's something that's probably not in my hands. So, and we see the issue across asset classes. If you look at the debates in equity land around double volume caps, the counting there, and share trading obligation, Brexit is definitely throwing a spanner in the wheels here. And since we don't know how this will end up by year end, I consider it a clear risk to the functionality of consolidated tape one way or the other.
So we will continue to work on post-trade transparency and, of course, the consolidated tape. For those of you who don't know, ICMA has written a report on consolidated tape. It is on the website. You can access it there. but I guess this leaves me just to say thank you very much to Stefan, Liz, Daniel, and Eric for their excellent contribution to this panel.